Wall Street Week Daily with our host of Wall Street Week, David Westin, who joins us every day at this time. David, and too big to fail, words that we've been talking about since the global financial crisis. And if regulators get their way, that list of firms that are too big to fail might actually be expanded.
Exactly, Romaine. You remember those non-bank banks and all the complaints that they weren't getting regulated? Well, there's a prospect now they might actually get regulated. To take us through it, we have the dean of banking regulation in the United States of America. He's Rodgin Cohen of Sullivan Cromwell. Raj, thank you so much for being with us. So bring us up to speed on exactly what we know and don't know about what the regulators are looking at. I understand they reportedly had a meeting just last week.
Right. I read the report, and it was behind closed doors, so it's closed to me. But clearly, for years now, there has been the question of whether there should be greater regulation of the remainder of the financial sector, the remainder other than the commercial banks. And to your point, do we have systemic risk in any of them?
Well, and some of the people that are mentioned, at least in the reports, are people like BlackRock, people like Fidelity, Vanguard. What is the potential risk from your point of view? You understand the system so well. If something went wrong there, how could that pose a risk for the entire system?
Well, I think the only risk is that these institutions would have a wave of redemptions. They would then be forced to start selling stocks to really be able to pay off the cash necessary. But I think the regulators, the government as a whole, has to be very cautious here because of all the advances which these major index funds have been able to provide to let individuals, small businesses, charitable organizations invest at a low cost. And so there's a lot of good they have done, and regulation which would frustrate those very key principles could be very damaging to the economy and the social fabric.
How are they actually going to make this assessment? Obviously, it's not just on size alone, right? I know when this discussion was being had about the traditional banks, it was more about counterparty risk and other sort of factors that really did show there was some sort of systemic nature to that business.
Yeah, this is a great question because there's been a lot of debate as to whether the Federal Reserve got it right. I actually think they did. They have a list of 7 factors they consider for financial stability, and you can tweak one or tweak another or maybe add one or subtract one. But as a whole, they have it, I think, pretty much accurate. And to use those as the building block would make sense if they want to regulate anyone else.
When we start to talk about the BlackRocks and Apollos and these sort of behemoths and their importance to our financial system, if there is a shift in how we deem these banks, how we sort of regulate these financial institutions, do you think that there will have to be a separation of some of their private equity businesses or private credit businesses from the whole?
Now, I don't think that there has been much of a problem because these institutions are engaged in multiple lines of business. That used to be the theory. I think that has been largely rejected, and again, properly so. Maybe the first step here, rather than regulation, is to look for more disclosure to the regulators. Marty Gruenberg, chair of the FDIC and a member of FSOC, gave remarks, I think last Wednesday, where he cited the importance of greater transparency, again, not to the public at large, but to the key government officials. And before regulation, maybe it's important to figure out exactly what the problem is.
So, Raj, maybe a disclosure first, but if they get to regulation, we don't know that they will, but if they got to regulation, what would it look like? I mean, do they have capital requirements? Do you have liquidity requirements? I mean, we know how it looks for banks. How does it look for BlackRock?
So, again, I'm going to cite Chair Gruenberg's remarks because he pointed out that probably the mistake made right after Dodd-Frank was to treat non-banks as banks for regulatory purposes, and he referred to a binary analysis, which isn't exactly correct. So you can't regulate an institution which isn't a bank, whose right side of the balance sheet isn't the same as a bank, the same way as you can regulate a bank. And it's going to take a lot of careful study as to what the regulatory structure, if any, should be.
And what, in your opinion, Raj, what are the potential effects on the overall system? That is to say, we often hear when regulations are brought up, will reduce liquidity, will actually make the system less effective. And particularly right now, as we're seeing higher interest rates, higher yields, there's a lot of stress on the system right now. Could this make things worse for the financial system?
No, potentially it could. Regulation is a desirable objective. You can't have unbridled financial institutions, but regulation is not an absolute good in and of itself. It can never be. And let me give one key example. Regulation to deal with individual institution failures is one thing. That's the lesson of 2008. But regulation to deal with exogenous events like occurred in 2020, that's something else entirely. So this will need very careful analysis and study before any regulatory scheme is imposed.
But do you get the sense that these proposals are sort of born out of the idea of what happened over the last couple of years, meaning a response to something exogenous rather than the actual collapse that we saw 15 years ago?
I think that they are, because everyone is looking at 2020 from what you can read. But again, I think you need a very different regulatory structure to deal with the exogenous event than with the particulars of the individual banks or other financial institutions.
Quickly here, Raj, back at the ranch, we also have regulations for the regular banks, not the non-bank banks, the banks. We've got increased capital requirements, we've got SEC requirements. What are those looking like right now?
So that is a real issue, and is anyone taking a holistic view of the entire range of regulations? So you have capital, you have long-term debt, you have resolution planning, special assessments are going to take a big bite out of earnings in some quarter. The Community Reinvestment Act regulations are going to drop, I think, very soon. And then when you look at the banks, you have a number of consumer regulations which are affecting the bottom line. You've already had the NSF issue. We're going to have a reexamination of late charges on interchange fees. So there is this incredible amalgam of regulation which is occurring. It's probably the greatest in certainly 15 years, if not in our lifetimes. And so looking at this, again, holistically is really critical here.